Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Robert Stark, President and Deputy CEO, Nomura Asset Management International. Robert, really appreciate your time, so thank you, and it's a pleasure to meet you, at least virtually.
Thank you, Todd. Really looking forward to this. Thank you for having me. Looking forward to this dialogue.
Well, as am I. So to kick off with, you've played a key role in building Nomura Capital Management. Now you've stepped into a bit of a broader role as President and Deputy CEO of Nomura Asset Management International. So how does this new role reflect the evolution of Nomura's asset management business, and ultimately what's your new priorities at the platform?
Yeah, sure. Maybe let me start by giving you a little bit of history on Nomura as a firm.
That'd be great.
So Nomura is a Japan-based financial institution. We celebrated our 100-year anniversary last year. So we've been around for a century, and we have 4 businesses globally. The first 2 are wealth management and banking. Those are Japan domiciled businesses. In fact, wealth management is the business that the firm was founded upon 100 years ago. So we serve 5 million households in Japan, all branch-based. And in addition to that, we have a big banking business in Japan as well. But those are more sort of local Japan domiciled businesses. And then the other 2 businesses are more global in nature. One is our wholesale bank, that's corporate investment banking, truly global business. And then last but certainly not least, we have the asset management business, which globally is around 850 billion in assets under management. The vast majority of that is in Japan. So we are top 3 asset manager in Japan, with the largest wealth manager in Japan. And then we manage about 250 billion of assets outside of Japan. That's essentially the way to look at Nomura as a group. Now, obviously, we would like to increase the earnings base of the firm, and while doing so, also shift more and more into fee-based businesses. And that gets you right into asset management. Given our significant size in Japan, to us, the growth market to do that is predominantly the US, but also other markets outside the US and outside of Japan. And that brings you right into what we have recently created, and that is Nomura Asset Management International. So we manage around 200 billion in assets across public equities, fixed income, multi-asset, and private credit, servicing wealth clients as well as institutional clients and the consultant base.
So when you think about NAM International, obviously it represents a significant step in bringing together Nomura's global asset management capabilities. Ultimately, how does the platform come together today across regions, and what are you looking to build over time with it?
Yeah, prior to our recent acquisition, that brought with them about 160 billion in assets in the US, but also overseas. In the US, we had only been a credit shop, serving or dealing mostly in the high yield markets as well as the private credit markets. Um, but it was the largest investment capability outside of Japan. Now, with this acquisition, we actually have a sizable footprint here in the US. And the sort of the future where we're headed towards is that you have a Japan domiciled asset management business and a non-Japan business. So the direction of travel is for Nomura Asset Management International to be the business where we manage all our activities from an investment and client perspective outside of Japan. And then we have Nomura Asset Management, which is the core business that we have in Japan. That's essentially where we're headed towards. In order to achieve that, as you might imagine, we have spent numerous hours developing. You can't actually, you have to go beyond hours. We're talking weeks and months of hard work figuring out how do we integrate these businesses and what is the strategic travel going forward, what are our core priorities, both in terms of enhancing our investment capabilities as well as figuring out how we can further increase our client footprint and create an operating infrastructure that allows to scale in a very efficient manner.
And speaking of scale, what are some of the key areas of strategic focus as you scale? And then how do you think about, wealth, ETFs, and ultimately the growing, obviously private markets seemingly is growing everywhere into that strategy?
Yeah. Let's separate two things here. Let's separate
Sure.
investment capabilities and then vehicle preferences. So those are two separate things. Obviously, they go hand in hand. But from an investment capability perspective, we are putting a lot of emphasis on income. So further emphasizing of us becoming a fully fledged income solution provider across the public and private credit spectrum. That's definitely one of the key themes. A second one is to strengthen our multi-assets investment capabilities and the solutions we can provide to institutional clients as well as wealth clients. The third pillar being strengthening our equity capabilities. That has a lot to do with available data, leveraging the latest technology to derive investment insights. That's more on the fundamental side. And then last but certainly not least, we also in the process of expanding our systematic investment capabilities next to our fundamental capabilities. So that's it from a pure investment capability perspective. The second part is how do you deliver those investment capabilities to your existing and future clients? Clearly, there's a preference, if we just take the US wealth market, for example, shifting away from long-only mutual funds into actively managed ETFs, for example, SMAs, model portfolios, and the likes, or CITs when we talk about the retirement plan system. So those are vehicles of the future, kind of replacing what you currently still have on the mutual fund side. And institutional clients, quite frankly, have always been at the forefront, whether it's through separately managed accounts or in the form of private funds. So that is definitely an area where we see a lot of growth going forward. And then separate from the public side, as we are thinking more about the private side of things, especially in private credit, but also other areas, here, given the liquidity of the underlying instruments you're using, you need to think about fund structures, whether that is interval funds, tender offer funds, non-traded REITs or BDCs and the likes, just to name a few. Those are definitely vehicles that we are contemplating about and in some instances have already put in place.
So obviously you reference private credit. It seemingly has become a big topic these days. As we look to kind of shift the conversation into a bit more of a private credit scope, where does that fit within the platform, private credit?
Yeah, private credit is one of our core growth areas. So we have invested for the last couple of years in building out a private credit team. You can expect us to do more, both organically and very likely also inorganically in this space. And the way we think about the private credit markets is in a fairly diversified way. So we define private credit as everything across asset-based lending, real estate lending, specialty finance, and corporate direct lending. So to us, the private credit opportunity feels more like a 15 to 20 trillion dollar opportunity, and it goes way beyond direct lending. That's how we sort of invest across these markets on behalf of our clients. So we see a huge opportunity in those markets. And we believe this is just at sort of where the early beginning of the growth of these segments. Now, you need a broad origination network, you need sound underwriting judgment, and you need to ensure that you put in place covenants that protect you in case of delinquencies or other breaches that occur in credit investing. Investing is all about managing the downside. So that is kind of what we get towards, and we believe in this regard, diversification truly matters, and diversification comes across a whole variety of things, whether it's markets within private credit, whether it's different borrowers, whether it's different type of structures. All of the above are really inherently important as we are building out portfolios on behalf of our clients.
Private credit obviously has been also in the news for some negative reasons. I think obviously there's been headlines and then what's actually happening in the market. Where do you see the market today? And then also, how do you kind of handle client questions? Because I presume you're probably just getting more questions. Hey, I saw this article here, or I read this headline here. How do you kind of manage clients through those questions to give them a bit more of a realistic look at where the market actually is?
Yeah, two things here. First of all, it's always a good idea to be proactive with your clients.
Yeah.
So we have regular dialogues with all of our clients, whether it's in the form of one-on-one conversations, providing access to our investment team, to our CIO, webinars, and all of the above. So that's an incredibly important piece to begin with. Separately, you are right, there is noise in the system, definitely, but the noise seems to be fairly isolated on select sectors within private credit. So when you hear people talk about software, that definitely is an area to look into, but software is fairly isolated, especially on the direct lending side, and within that, especially on the BDC side. But if you put it in the grander scheme of private credit, the way we define it, it's actually a 1% to 2% overall exposure. Now, if you just zoom in on direct lending and by BDCs, that maybe gets to 10 to 20% of that exposure. But again, in the grander scheme of things, it is actually a fairly small issue, but it gets a lot of attention from the news for all the right and all the wrong reasons. AI, just to give an example here, I'm sure there will be certain software companies who will struggle with that, whose business model may be at risk, but there will be others who are actually going to greatly benefit from it. But it's way too early at this point to have a better sense of the ultimate implications. And we're watching this closely, but again, in the grander scheme of things, it's a fairly isolated topic, but it does get a lot of media attention. But we're not really concerned in the grander scheme of things, and certainly not concerned as it relates to our own portfolio that we manage on behalf of our clients.
You referenced obviously the credit. You don't manage the upside; you manage the downside. How critical is structure when thinking about private credit, and ultimately, what should investors be paying closer attention to?
Yeah, I mean, so every loan that we provide is thought through in the spirit of not only its own individual loan, but also how does it fit in the overall portfolio? Does it add diversification in areas that we need it? So while we look at each individual loan from its own terms, the borrower, the covenants, and all of the above, it is equally important to think of it in the spirit of portfolio construction and diversification. So we feel very confident in having a highly diversified portfolio of loans, where the idea is to provide yield in a diversified way across the credit spectrum, as opposed to doubling down on certain borrowers or certain sectors, because we see significant demand in those sectors. As I was alluding to earlier, we are not getting paid for upside. We're getting paid for clipping a coupon and getting paid back the principal. That's what we're managing towards. We're not managing towards one or two loans shooting the lights out. That would be more in the equity and venture department. That's not what we do in private credit. And so that mindset is incredibly important. And that's also when we talk to our clients, how we think about portfolio construction, how they should think about investing in the private credit spectrum plays a significant role. Now, obviously, we're not making the decisions for them, but I think it is our duty to explain how we think about private credit, how we think about investing into those markets, and then how we do this with what type of vehicle, etc. So that's something that we feel very strongly about, and we really feel as fiduciaries, we owe it to our clients to provide the clarity and transparency and the education that is necessary for our clients to understand it. And the easier it is for them to understand it, the easier it is for them to explain it to their clients.
So you also referenced earlier that you guys look at private credit as this wider universe. Asset-based finance, real estate, specialty finance. When you think about that, why is that important to look at it through that wider lens? Because I still think private credit, there's too much of this, it's corporate direct lending view, which private credit today is certainly more diverse. And then second is, where do you see kind of the most compelling opportunities in today's market?
Yeah, I mean, look, it's fair to say that private credit, first and foremost, predominantly grew in the direct lending space on the back of private equity deals. So that's why most people still believe that private credit equals direct lending, even though direct lending is only a small portion of the overall private credit markets. Now, we feel that diversification in that matters, and we see significant opportunity in areas such as asset-based lending and real estate lending, both on the commercial as well as the residential side. We feel that we can get paid for both complexity and illiquidity in those markets fairly well, given the risk that we take in these markets, especially if then compared to the corporate direct lending markets, which seem to be a little tight, and there seems to be an imbalance of supply and demand. So that's why you see us in a diversified manner really seeing significant opportunities in the other sectors, i.e. asset-based lending, real estate lending, and specialty finance.
How should advisors think about, either balancing income generation with downside protection across these various markets?
Yeah, um, I would encourage advisors to really think about when they say private credit, what are you actually getting exposure to?
Yeah.
That's one important point. Truly understand if you think about individual structures or strategies, what is the underlying exposure? Number one. Number two, how is that correlated to the public markets? Um, bank loans, also the leverage loan market, the high yield market, and the likes. And then what's the illiquidity premium you're getting? And then last but not least, I would also encourage advisors to think about the vehicle that they're investing in. Is it a levered vehicle? If it is levered, how much is it levered? That is also an area for advisors and their clients to pay attention to, because you don't want to end up in a highly levered vehicle, and if there are issues or cracks in the underlying market, having a highly levered vehicle could potentially become an issue.
The current environment, obviously, you have some bad headlines. We have wars, uncertainty, macro conditions. How does that reinforce that important piece, which you've talked about a few times in this conversation about diversification across private credit?
Yeah, I mean, we're obviously following closely the macro environment, interest rates, Fed policy, and so on and so forth. Um, that plays a role, but quite frankly, it doesn't really play a role in individual loan decision making. So you got to isolate those two topics. You got to better understand, though, how, in the context of the macro environment that we're dealing with, how our market's going to evolve. So it informs our views on certain sectors within private credit, whether we are overweight or underweight certain sectors. Um, so it does play a role, but I wouldn't say it's like it bothers us on a daily basis. It's more like having the macro picture in mind. Interest rate policy is obviously a lot more relevant than
Yeah.
like the war side of things, even though also that has downside implications over time on certain sectors and industries, including inflation.
When we think about the advisor community, and when you speak with the advisors, what are some of the most common misconceptions, when they're talking about allocating the private credit?
Yeah, the first one is that people think private credit equals direct lending,
Yeah.
right? And I can't blame them because we've seen significant growth in direct lending,
Hmm.
Um, so that's the first one, that making people aware that the bigger opportunity in private credit sits actually outside of direct lending, asset-based lending, real estate lending, especially finance. And a lot of those loans are up for maturity, and they are still sitting on large banks, commercial banks, regional banks, and the like. So there's a significant opportunity in those markets. There's a lot of illiquidity and complexity premium still to grasp. And so showing advisors and their clients the opportunity beyond direct lending. It's also much less correlated to the public markets, and offers the opportunity for income diversification and growth. And so that is an area that we very frequently are in dialogues with our clients, such that they are aware of that. The other thing I think that is a little bit of a myth is you hear a lot about gating,
Yep.
and I'm sure you've read at least one too many articles around there's gating going on, and that's actually not quite accurate. I think what you see happening is a statutory limit for certain fund structures. Usually it's 5% per quarter, and that's what you are guaranteeing your clients every quarter. So that's in fact, how we manage the fund, its liquidity profile, it has an impact on maturities, and it has an impact on the yield that we offer, the leverage, the financing of certain transaction. So all of that plays a significant role. Liquidity management is incredibly important in that regard. Now, I think the misconception is if you hit that 5%, it's fine. Like it's 5%. But if more than 5% of the outstanding fund shares would like to redeem, but you keep it at 5%, that is not gating. Instead, what is happening is every investor will be prorated. But the news outlets or most articles that you read will call this gating. But it's factually not true. What is true is that the advisor is a fiduciary and needs to manage to its fiduciary obligations within the statutory limits of the 40 Act rules. And that is the 5%. It's no different than hedge funds, for example. The main difference is slightly different parts of the code. So that is something that I think is a significant misconception. And so when people hear gating, they think that the manager is doing what they're not supposed to be doing. Instead, the manager is doing exactly what they're supposed to be doing, because you don't want the manager to be forced to liquidate performing loans. That is not in the interest neither of those leaving nor of the investors remaining in the fund. So you got to manage towards your entire shareholder base as fiduciaries in these structures. So those are two of what I think are common misconceptions of the private credit markets.
Obviously, you referenced, kind of my next theme of questions, which is education. How can we get better at educating not only the end investors, but also the advisory community? Because I wonder if the news articles are talking to advisors and they're getting this, all right, well, they're gating my investors. Like, is there a misconception because the education maybe across certain segments of the market is not where it should be?
It's probably true. I think while the vehicles in itself have been around for decades, I think the application are still in the earlier days. And so, markets and advisors and clients learn through cycles, and we haven't been through a full cycle, still haven't been through a full credit cycle since the global financial crisis. And so there's definitely an experience missing still. That being said, education is absolutely critical in this regards. Typically, when we start a dialogue with a client or a prospect, rather, before we even talk about an individual strategy, it's really talking about markets. Like the first 2-3 meetings is still at that level. And then after a while, you get more and more deeper, you understand how the clients thinks about certain parts of the market, certain asset classes. And then once you drill deeper and eventually talk about structure, we make it always very clear that while there is quarterly liquidity, you cannot assume these type of vehicles being liquid ever. And so the way to think about allocating to these markets with these type of vehicles should rather be driven by longer term core allocation in someone's portfolio. And when you think about portfolio construction, what we encourage each advisors to also think about is not only the risk return and the risk capacity of their clients, but also the liquidity needs. Because there is a chance if you allocate 2 to 5% or whatever the percentage is to private credit, for example, or other private markets, there is a very high chance that you can't get the money out when you want it out. So you almost need to think about your portfolio as in a fully liquid bucket and an illiquid bucket. And that then also goes down to, should everyone be entitled to have access to these type of structures? My personal view is no. I think there is definitely a clientele and upwards who are more suitable for these type of exposures. And that's also one of the areas. Obviously, it's not our decision to make who should and who should not be entitled to invest in these vehicles. That's the advisor's role at the end of the day and their fiduciary responsibility. But we definitely try to explain it to advisors numerous ways through individual conversations, dialogue with the investment team and the CIO, white papers, and so on and so forth, and webinars to ensure that people understand that investing in these markets should not be considered with an eye on I can get my money out at any point in time, because that is not the case.
Do you think you certainly described what a good education could look like with the white papers, webinars, and obviously an information flow. Can the asset managers be doing a bit more to kind of help with that educational piece and making sure, all right, maybe this is where the product should be pointed to, or this could be the better type of investor for this product?
We can always do more, without a doubt. I do feel we have come a long way already. But as you can see from the latest couple of months of news cycles, it doesn't take much to create noise in the system. So the more education you do on a regular basis, the more people will also understand the markets as well as potential implications. And if someone would like to redeem, but it's prorated.
So, we've obviously been talking a lot about private markets, but public and private is converging more than ever today, it feels like. How should advisors think about this convergence? And then where does each kind of play its own distinct role when it comes to liquidity, pricing, income generation?
Yeah, I mean, this is already happening and has been happening for quite some time with institutional investors, that they think about whether it's income or whether it's growth in terms of public and private buckets, as opposed to purely public, purely private. So we think about how do we provide a certain yield given a certain risk tolerance of clients on the institutional side. So that's already happening there. I would imagine that we see more and more of that on with wealth clients as well. Whether that happens in the form of, it depends on how much do you want to actually in any given fund structure allocate to the private side of things. That will sort of determine the underlying fund structure that's probably most suitable for it. And you've seen attempts to put it all into ETFs, for example. I'm not sure I fully agree with that, especially if more and more of the underlying assets are more illiquid in nature. So I'm not sure that's the appropriate vehicle for that. The more it is actually then in illiquid assets, the more likely you have you're going to choose a vehicle that has a quarterly redemption feature, because that's what the manager will need to manage it appropriately. But you can also go beyond individual fund structures in the form of SMAs or UMAs and other types of programs that then allows the manager to manage these sort of like overarching archetypes in a more tax efficient manner. Obviously, you need a minimum amount to do that from a client flow perspective. So that's definitely not going to be available to everyone. But again, it comes down to what are we trying to solve for? What's the if you're telling me I need 10% plus yield, like inevitably that will need to come to a significant extent from the private side. But if you're happy with, I don't know, 6 to 8% and a little bit of boost, from a total returns perspective, yeah, then you probably don't need 50% plus on the private side of things. So it really comes down to what's the ultimate objective that you're solving towards, and what's the risk tolerance that for either any given client or for a particular vehicle you would like to manage towards.
One question I've asked a lot of others is, as we push to try to get private markets to maybe reflect what public markets look like, do we end up pushing too hard where it ends up being they look too similar and then the illiquidity premium is eroded? Or is that all based on a secondary market and needing to ultimately trade some of these? Because it feels like, we have some benchmarks in the private space now. Transparency has increased. Does some of that illiquidity premium eventually erode?
Over time, I would agree, yes. The illiquidity premium over time will erode. But you will also see more and more specialized markets as the markets grow in their own right. So there will always be a liquidity and complexity premium to be caught. That being said, having more data and more transparency is going to help everyone, not only to better understand these markets, but also to further broaden these markets. And then you will see further bifurcation between what is a true beta exposure to a certain private credit market, for example, and what is true alpha. So it becomes probably more of the market over time might be accessible with a beta play, given better transparency, better data, better access. And then where do you get the alpha from? And that's probably going to be more and more in niche markets, as well as in complex markets where you simply, by virtue of these markets being highly liquid and complex, that's how you derive your premium at the end of the day. But we're still a far way from getting there. But even if you, it sometimes helps actually not look forward, but look back and how far we have come. We have come a long way, but not nearly as far as we need to over the next decade, let's say, to fully get there.
You referenced obviously the liquid interval fund structures a little while ago. Obviously, they've become a key piece to the headlines in the news recently. What are some of the advantages of these funds? You obviously referenced who they should be sold to and maybe who they are sold to, and then how should advisors maybe think about these vehicles versus the traditional structures?
Yeah, and I would say first and foremost, it's not only interval funds. You can name tender offer funds, non-traded BDCs, non-traded REITs, operating companies. There's different ways. At the end of the day, what all of these vehicles have or fund structures have in common is they provide access to an audience, to markets that they typically do not have access to. And if we stick to private credit for that matter, they give you access to particular private credit markets that you normally do not have access to, because you would need to have at least $5 million of investable assets. And even if you do invest in a 3C7 private fund, your money is locked up for at least 6 to 8 years, sometimes even longer. So that doesn't really work with, quite frankly, the vast majority of the millions and millions of households that would like to have access to these type of markets. So these vehicles are actually a way to bridge both having access, but allowing the manager to do what they need to do, and that is to garner the illiquidity and complexity premium in the form that that liquidity isn't a necessary evil on a daily basis. And so that is an area that we feel not only provides access, it also is tax efficient, so 1099, no K1s. They are, depending on where the advisor sits, but at least on the On the RA front, through the classic custodians, you can buy these funds point and click. So it's easy for an advisor to add these funds to a client's portfolio, similar to buying a mutual fund and an ETF. It's a little bit different on the broker-dealer front, both the wirehouse and the independent. They all have their own policies of how they do this. So it's easier to trade and to transact. That's obviously going to make it easier to allocate and to add it to portfolios. And it has all the bells and whistles of customer protection that comes with the 40 Act. No different than all the shareholder provisions and protections that come with mutual funds and ETFs. So it's treated in the same way, way beyond the requirements you have in private funds, for example. So I feel very confident that this is an area that rightly so has a lot of opportunity to grow, but it is not going to happen if we don't educate better, if we don't move through cycles in a positive way, and protect investors from themselves. And these structures actually are designed to do just that.
So if we start looking ahead a bit, private credit obviously will continue to grow. I've heard, someone quoted a number to me earlier in the week, 45 trillion. Whatever the opportunity is, it's obviously quite large. But where do you see the potential risks building in this market as we continue to grow?
The biggest risk is always if growth happens too fast, and then you have you no longer make sound underwriting decisions, whether it's the wrong covenants, the covenants are not hard enough, or you don't have the appropriate workout capabilities, being prepared for managing across the cycle. Those are things that typically happen when you grow too fast. When you're when you're not diversified enough, when you are too reliant upon single borrowers, for example, or single markets. So concentration is the enemy in credit. So avoiding that at all costs is incredibly important, because investors look into these instruments more like, while more risky, clearly they're expecting a certain coupon and yield, and ideally deliver that yield with as little volatility as possible. Now, there will always be volatility, but it's very clear that investors are more comfortable with equity market volatility than with credit market volatility, and that's definitely something to just be mindful for or about, and which is why diversification again is quite important.
On the flip side, what gives you kind of confidence in the long-term case for this market? Is it the diversification piece that obviously you've referenced many times?
It's diversification, but it's also when I look at how much credit is still on the bank's balance sheet, commercial real estate, residential real estate, various asset-based lending markets, we see a ginormous opportunity in the years to come. We feel very confident that this is an area that will be attractive to our clients, where we can reap the benefits of the illiquidity and the complexity premium, and that is going to ultimately benefit our clients. But again, doing this in a diversified way, way beyond the corporate direct lending side. So to us, over the next couple of years, we see ample of opportunities in these markets.
So we have just a few minutes left. I always like to end the episodes with some fun questions. So do you have a favorite sports team and/or hobby?
Both. Hobby, tennis. I love playing tennis, and sports. Being from Germany, I'm a huge soccer fan, or as we say, Fußball. Now with the World Cup coming up, and in Germany playing here. This is definitely probably my favorite sport. Although I did acclimate appropriately to the U.S. sports system. So American football is pretty high on the list of our children that were all born here in the U.S. So definitely trying to strike the right balance. But having the World Cup here in the U.S. is going to be a huge booster to instilling more soccer feeling into my children.
One surprising thing about yourself.
Well, as I was alluding to, from Germany, but I'm first generation immigrant into Germany. So I was born, when I was born in Germany, my father was Austrian and my mother was Colombian. And so there's a lot of history that comes with that. But I was essentially first generation immigrant, and my wife and I, we have basically repeated that to our own children who are first generation immigrants here in the US. So it's gonna be interesting to see where they set up shop in the future.
One book that you'd recommend reading?
Yeah, it's a short book, but it's a great one. It's called The Four Agreements. It's by Don Miguel Rios, and that book basically talks about four things that are fairly intuitive, but when you read it, you get reminded about all the things you do on a regular basis that you shouldn't be doing, like be impeccable with your word, right? Say the right things. To don't take anything personally, and doesn't matter how often you tell this to yourself, like you always take things personally. The third one is don't make any assumptions. Like don't make an assumption what someone else thinks about you, because it's highly likely that they don't even think about you in the first place. And then last but not least, always do your best every day. And every day, yesterday wasn't great. Today, give it your best.
Most exciting part of your job?
Most exciting part of my job, being with my team. That's the most. This is a people's business. I am very grateful for the team we have built here at Nomura. This is a growth business for us, and I could not be more excited to do this with all my colleagues and partners and team members. And that's essentially what matters the most.
And then final question, one prediction for the next 12 months.
All right, it's going to happen sooner than within the next 12 months. Germany is going to win the World Cup, of course, here in the US.
I think that's a perfect place to end it, Robert. I greatly appreciate your time. So thank you very much. Continued success to you and the team, and hopefully we'll get you back sometime in the future.
Thank you so much for having me, Todd. This was fun. Thanks.
Yep. Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.